Hi, folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we'd come to you today with a brief market update, kind of let you know what's going on out there to start the week. Once again, a little bit like Mr. Toad's wild ride within the marketplace. S&P 500 right at about 5430 as I'm speaking. That's down about 7.5% year to date, down about 12% from the sort of February 19th peak in the marketplace. So if we were measuring this, we are still in correction territory, those down 10% plus events that happen usually at least once a year. But keep in mind, back to that sort of Mr. Toad's wild ride analogy, from April 2nd to April 18th from April 2nd to April 8th, over that kind of 6-day period, the market dropped about 12%. By the way, that was over a weekend, so not total trading days. And then from April 8th to April 14th, we had about a 9% gain in the marketplace. So, if you look at the charts, you'll see this like dip down and then, spike right back up again on the other side. And this is, I think typical of the wild ride we've been exposed to with news on tariffs. On the one hand, we'll get an announcement of sort of very broad sweeping tariffs. And then later we get an announcement by the administration that maybe those tariffs aren't going into effect. We'll get, kind of a trade war with China, but then we'll get the idea that electronics might be exempted from that trade war or, exempted from some of our other trading partners. And then today we'll find out that exemption is only temporary, that, there actually will be some trade barriers that go into effect on electronics. It's just not yet. So they're trying to figure that out. And I would just note that this sort of deliberately on again, off again, is it happening, is it not happening, is probably somewhat intentional by the administration. Because if you think about their efforts to negotiate with our trading partners, they want to demonstrate credibility. They want to demonstrate that they are actually willing to go through with these tariff packages. Because that will hopefully help them negotiate a better deal on the other side. If the countries that we're negotiating with think that we're full of hot air about enacting some of these protectionist measures, then they're less likely to give us a good deal. On the other hand, in the meantime, while you're trying to communicate to them, yes, you're serious about this, the market is taking away those particular communications and getting very nervous and scared about them because trade wars are painful. They're called a war for a reason. And so that is a little bit, you can't kind of have your cake and eat it too. In an ideal fashion, you'd be able to communicate seriousness to the other side, but just a negotiation tool to the market and be able to navigate through this. You can't in this instance because you only get one set of communications to deal with. Second thing that I would just note is, we are off 7.5% year to date and about 12% from the peak when we first started to announce a lot of these things. Look, while we have backed off on some of the more aggressive trade protectionist policies, we haven't backed off on all of them. We certainly still have trade protectionism in place with Canada and Mexico. There are tariffs there. Clearly, we've gone sort of full bore trade war with China. They are a significant trading partners of ours. And we still have other tariffs in other locations. If you look at the effective tariff rate in the United States, it's jumped up from close to 0 to almost 10%. That will have an economic impact. We will see that price increase in inflation. We will see potentially slower overall economic activity due to higher prices that consumers have to pay. And so it's not actually that surprising that the S&P 500 is off. It's off its lows because we haven't gone sort of full to the floor with this stuff. But keep in mind that we still will have significant economic headwinds going into the second and third quarter just based on the stuff that we've already passed. So that level kind of makes sense to folks, certainly makes sense to most market participants. Meanwhile, the bond market has been attracting a lot of attention recently, the news flow around them, because the yields on the 10-year have sort of risen from about 4% up to about 4.4% most recently, spiked all the way up to 4.5%, but today we're settling in at about 4.4% yield on the 10-year. And there's been a lot written about this. A lot, particularly at the end of the last week. Is the U.S. becoming not the world's safe haven? Maybe our currency and our bonds are starting to trade like emerging markets as opposed to the world's reserve currency. And, maybe, we'll see certainly if you think about trade balance, if we reduce the size of the deficit, that then reduces the amount of money that foreign countries have to buy U.S. bonds. That's just basic trade math. And so maybe if we've eliminated our trade deficit with all of these folks, then that becomes a less of a source of people to be able to buy U.S. or U.S. dollar denominated fixed income. We'll see. I think the bigger explanation for what's going on in the bond market is actually related to the Fed and inflation. If you think about tariffs, as we talked about before, they are inflationary. They are, in effect, a sales tax placed on American consumers when they buy foreign goods. And as we've talked about previously, estimates are anywhere around, it may add a full percentage point to CPI inflation measures, maybe even 1.5% to CPI here in the second and the third quarters. And that puts the Fed in a little bit of a pickle because on the one hand, presuming that we see the economy slow as a result of that, they may be tempted to kind of cut rates. And certainly that was the way that the bond market was acting when we saw Treasury yields fall from kind of the mid-4s all the way down to 4%, maybe even a little bit below it, right? Is this idea that, oh my goodness, a recession is coming or an economic slowdown is coming, so the Fed's going to need to cut rates here. And then late last week, a bunch of the Fed officials came out and said, whoa, not so fast. Remember, we have a dual mandate here. We not only care about unemployment, but we also care about what the inflation rate looks like. And since tariffs are inflationary, we may not be able to cut interest rates in response to a weaker economy, or may not be able to cut them as fast as you might like us to. And so we're going to have to wait and see here. And the Fed, by the way, is a little bit learning from its own mistakes. If you think about COVID, everybody thought that those were sort of transitory, one-time inflationary impacts. And so the Fed was a little bit late to the party in terms of actually raising interest rates in response to inflation there. Here, the Fed's saying, before we just treat those, that tariff-related inflation as a temporary external phenomenon, we better make sure that's the case. And so this sort of evolving narrative from the Fed late last week, I think, brought us to a point where the Treasury market bounced back up to about 4.5% on the 10-year, which is right around where federal funds is. So you saw Treasuries collapse on the one hand you saw Treasury yields drop pretty significantly when this first news came out, which was like, oh my goodness, we're headed into a recession, the Treasury is going to be able to cut rates. And then Fed came out and said, yeah, not so fast. We don't know if we'll be able to cut rates because of the inflation due to the tariffs. So in my mind, that's actually the reason for the move on the 10-year, not necessarily that the rest of the globe is looking at the U.S. financial system and saying oh, it's in peril, it's not going to work anymore, et cetera. I think there's a much simpler explanation, and usually the simplest explanation is the best. So with that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.